During the last two recessions, we saw that although fewer dollars were invested, more companies did actually get funded. In addition, over half of Fortune 500 companies were created during a recession or bear market, and over 50 tech unicorns collectively valued at around $145 billion were founded during the 2007 to 2009 recession years. Funding to MENA startups hit US dollars 277 million in the first quarter, up by 2% from a year earlier, even though the number of deals dropped by 22%. Welcome to the second episode of Restart, a 10-part podcast and webinar series that deep dives into the future of different industries. Today, we discuss the future of the region's startup ecosystem, and joining me on this panel, we have Amir Hegazi, who's a global entrepreneur and author of Ecosystem Arabia. We also have Philip Bahoshy, who is the founder and CEO of Magnet, an online MENA startup ecosystem that connects entrepreneurs and co-founders, investors, etc. And also joining us is Sharif El-Badawi, who serves as a partner at 500 Startups, the most active venture capital firm in the world. Well, thank you so much for joining us.
Yeah, well, first of all, thank you for the initiative by Arabian Business. I think facilitating discussions from key stakeholders around challenges, opportunities, ideas is one of the best ways to get us past this crisis and into an exciting future, an exciting ecosystem, which I remain super optimistic about, actually. So the book was released 2 months ago. It's called Ecosystem Arabia, obviously relevant to our topic today. It addresses the fundamental blocks of building a thriving ecosystem using the Middle East and North Africa region as a case study. So what I've done is I've interviewed about 120 thought leaders, experts some are global as well as regional players, top entrepreneurs, investors, incubators, accelerators, policymakers, ministers, to get a comprehensive perspective on what's happening in the region as far as the startup ecosystem, as well as what are the gaps are, and what suggestions and recommendations on how to fill these gaps.
At this point during the pandemic era, have you seen a sort of friction or a hesitation from the investor side of things?
Many of them are saying that they're still investing. Clearly, many of them are focused on their portfolio companies as opposed to making new investments. But the truth of the matter is it depends on how much dry powder or how much cash they have available to invest. So I don't want to say that they're hesitant, because we've actually seen investments being made and continue to see investments being made. But clearly their risk appetite is very different now to what it may have been 6 months ago, if not 3 months ago. But the trends are showing, if I can highlight what the numbers are showing for this year, is that there's basically an 18% increase in the amount of capital deployed, but a 40% drop in the number of deals. And so my takeaway is that investors are making larger bets in more established companies they believe will navigate and get through this crisis, rather than riskier, smaller bets on companies that previously they would have been interested in because of their growth stories, but now a little bit more reluctant to participate because they're not sure how they're going to survive the next 12 to 18 months.
The number of deals is expected to decrease simply because some are waiting to see, and we've heard this firsthand from our founders that are out there pitching. Investors have told us that directly as well, that they don't know when this is going to end, so they don't know what they should be looking at to invest in now. And if their fund vintage is 2019 or 20, they have still a period of time to make those investments, right? So they could wait 6 to 12 months and then start deploying all their capital, because they've already locked it in from their LPs. Which is another perspective to have, is where do the VCs get their money, or where do the investors get their money in the first place?
It looks to me like the trends are slightly different from what happened in the previous recessions, because last time we saw that there were more deals done in terms of investor deals, but this time we're seeing there's more amounts being put in than the number of deals, like you just mentioned right now. Why do you think that?
Well, I'll just jump in and say, I mean, this is very fresh, right? So in fact, I would caveat the numbers that I mentioned as saying, when you look at the largest deals of EMPG, Katopi, Visita, all of which were done in March and April, they're likely to have been a good 6 to 9 months in discussion already, at which point the investments were made. So we know, and Sharif can advocate to this, that investments are very rarely done overnight, and they'll probably be a long time in the making. The true impact of this, you'll probably see at year end, because after the summer, how much as things come to fruition? What are investors going to be saying when they come back from the summer? Will governments be supporting and injecting cash through sovereign entities? We have the likes of ADIO, you have Dubai, you have Jeddah and Saudi. So I just kind of tampering the comment just to say it's a little bit too early to tell whether this is actually going to be the case for 2020, but that's the direction in which it's heading for the time being.
You know, we have a bunch of, players, and then whoever is well positioned next to that seat, once the music stops, is going to have their seat. And then there's going to be others who have to scramble and pivot, in a sense, adapt their models, and restructure as needed to be able to kind of go on the next phase. So to Philip's point, I think there's going to, obviously the investor is going to be more consolidating toward those industries, a lot more so than traditional industries. And then we'll see corporate players that are looking to adapt and quickly accelerate their digital transformation, and fast forward really to what would have normally happened in 5 years or 10 years to next year. So that's it's ultimate accelerator in that sense.
As a venture capitalist, what do you think the criteria is going to be in the post-COVID era? Is there something, a direction that the VCs are going to go towards?
I think certainly. I mean, we're already seeing it to some degree, which is by sector. So investors are looking more closely at sectors that are resilient to a crisis like this, and healthcare tech, ed tech, logistics, many parts of e-commerce subverticals, and fintech subverticals. Then sustainability. So agri-tech, which was sort of like an ugly duckling for your mainstream investor, starts to become very important in emerging markets where food sustainability is important. And it goes back to economics 101, which is actually a good thing for this region. We need to reduce the number of imports and increase the number of exports, and build our GDP that way and build jobs internally.
Investors and angel investors and VCs have said that the slowdown was much needed, especially at this juncture, because the market was getting saturated. So do you also agree with that, or do you think this particular time and this particular slowdown that's happening right now is a challenge?
I think particularly with e-commerce, I think the perception of saturation is relative to the demand, right? Because we know that the ratio of e-commerce to offline retail is very low, right? It's much lower than other parts of the world. It's 2% or whatever across the region. So then there's a huge gap, right? So the question is, why does it seem saturated? It's because there's too many players fighting for that 2% versus now what's happening with there's a lot of consumer behavior changes. We're going to see that demand higher, so which invites a lot more players to come into the picture, right? So I think it's not saturated by any means. It's just that the consumer adoption haven't caught up yet.
We are in the lowest single-digit penetration of e-commerce online transactions. For the population size we have, we're under-penetrating in almost all sectors compared to the rest of the world. So there's a lot of opportunity. It's hard to say that there are too many startups because these things haven't been addressed yet, right? So maybe there's not enough of the right ones. And on the funding side too, my last estimate I did last June was $16 billion behind in venture capital in this region for the amount of startups and opportunities we have. Compare that to the way the US, and the US maybe invests less than 0.3% of investing dollars into venture capital. That's nothing, right? And almost all the wealth over the last 40 years has been created by venture-backed companies. If you look at the top companies in the stock market these days, 90% of net new jobs have been created by SMEs and startups. So we are super underfunded still, even though there's over 200 investors recorded in the region by Magnet. So from so many of the macro sides, there's still so much opportunity. That's the point I want to make.
You touched on regulations over here a little bit. Is that one of the main challenges that you see among the startups and the smaller businesses that wish to build or establish in this region?
Yeah, I mean, so you can put it down to talent being the number one challenge. And that's because you need good people to build a good company. I think any founder will tell you you're only as good as the people that you have in your organization. But interestingly, a lot of the challenges around talent are linked to potentially regulation, visas, size of market, education. Regulation remains a big challenge across the whole of the region. People tend to forget from outside of the region that the Middle East and North Africa is not the United States. It is not one entity. It is broken down by 17 or 18 countries, depending on what definition you want to look at. Each one has a very different regulatory environment, demographic environment, purchasing power environment. And to be successful in the venture game, and I say this on behalf of investors, venture is not a charity, it is an investment. And for that, you require a return on that investment, and scale is the name of the game. And to be able to scale, you need to be able to capture market share, consumers in multiple geographies. And to be able to do that, you have to overcome a lot of bureaucratic and regulatory burdens in being able to operate in multiple jurisdictions to be able, now more than ever before, to at least be breaking even, if not profitable, as an organization within each of those geographies. So yes, but it's not just simply regulation.
Many founders, I think, would point to funding options as something that they challenged with. Investors, it's hard to feel empathy for investors, but investors will always say like there's not enough good founders out there, and I don't think that's true. We see 3,000 or so companies a year. We invest in less than 3% of them, and we're the most active, as you know. So even for us, we're hyperactive, investing in a handful of companies a month, and we see great opportunities, and we're passing on a lot. So I don't think it's those things. I think challenges should not be used as a reason to not do startups, or the reason why startups can't be successful. In fact, it's the opposite. It's when there are challenges, it's the ripe opportunity for entrepreneurship.
Do you see a lot of startups today creating products for investors and not customers and consumers?
I think it's a great question. I don't know that I can answer that specifically, because I don't know whether they're doing it for the investors or customers, but I'm pretty sure that the ones that are likely to get investment are the ones that are doing it for the customers and not the investors. Ultimately, you need customers and paying customers to be successful.
I've seen board members who are not even an investor telling the founders what to do and how to do it. I've seen investors do the same. I've actually seen investors pick a founder or an executive and say, go do this startup, we'll fund you. So that does happen. But I think the bulk of what you're talking about comes from the founders side, and probably the smartest founders we have in the region. They're just brilliant minds in whatever they were doing before. They've noticed an opportunity, and that opportunity is a real problem. So that's something good founders and evil founders need to do, is find a real pain point and present it to us, that, demonstrate it is a pain point.